380 companies hand their payroll to a single processor, their employee data, their bank files, their cash. Many of those companies have auditors, and every one of those auditors asks the same question. Can we rely on the controls at that processor? Nobody sends hundreds of audit teams through Cascade's door. One service auditor examines the controls once and issues a single report that the client companies and their auditors can all rely on. So one engagement can affect a great many audits. And here's the part people miss. Most of that quality is determined before anyone tests a single control. It is determined in planning. That is where we are going today. Welcome back. I'm Professor Lamptey. In this video, we discuss planning SOC engagement in two parts, because there is a great deal here. First, what has to be true before you accept the engagement? Second, what you need to understand about the service organization and its system. Part 2 covers materiality, the risks the service auditor assesses, and how those risks shape the procedures we perform. One example runs through all of it. Cascade Payroll Solutions, a payroll processor with 380 client companies, engaging us for a SOC1 Type 2 examination. Start where the standards start. You do not plan an engagement you should not accept. So what has to be true before we say yes? First, independence and competence. Independence means we have no stake in Cascade. We do not own it, we do not operate it, and our fee does not depend on what we find. Competence means we can actually perform the work. And SOC work is technical. Someone on the engagement team has to understand access controls, change management, and how Cascade systems really operate. That may be an IT specialist or an accountant who knows the technology. One quick vocabulary note, because the exam is precise about this. Independence and competence are acceptance requirements. Preconditions is a narrower term, covering things like having a responsible party and having criteria that are suitable and available. Second, management has to accept its responsibilities. Cascade prepares the description of its system, not us. We examine that description, but Cascade writes it. Cascade also specifies the control objectives, the goals the controls are meant to achieve. For Cascade, something like, payroll is calculated correctly and paid only to genuine employees. Management usually specifies those objectives. A law, a regulator, or a customer group can specify them instead. And then the description has to identify who did. Either way, we have to be satisfied they are reasonable for a payroll processor. Cascade then provides a written assertion. An assertion is management putting its own name on the claim. This description is accurate, and these controls were suitably designed. In writing, signed. That assertion is not paperwork. A SOC examination is an assertion-based engagement. Management makes the claim, and we test it. The attestation standards also permit what is called a direct examination, where a written assertion is not required. But SOC engagements cannot use that approach. So if Cascade will not sign, we withdraw from the engagement. And where we cannot withdraw, we disclaim an opinion entirely. Third, the criteria have to be suitable and available. Criteria are the yardstick we measure Cascade against. Suitable means it is a sound yardstick, and there are 4 tests. Relevant. It genuinely bears on the question. Objective. It is free from bias, not slanted in Cascade's favor. Measurable. 2 auditors applying it would reach about the same answer. And complete. Nothing important is left out. Available means the intended users can actually see that yardstick. Criteria are sometimes public. Sometimes they go only to specified parties, which is exactly why a SOC1 report is restricted. For Cascade, the control objectives tell us what the controls are supposed to achieve. We then ask 3 questions. Is the description fairly presented? Were the controls suitably designed to achieve those objectives? And in a Type 2, did they operate effectively throughout the period? In a SOC2, the yardstick is different. There, you use the trust services criteria: security, availability, processing integrity, confidentiality, and privacy. You pick the categories that fit, and security is always included. Fourth, the scope has to make sense. Ask who the report is for. A SOC1 report is intended for 3 groups: Cascade's management, the client companies, and the independent auditors of those client companies. That makes it a restricted use report. It is not intended for the general public. Watch this one because students consistently get it backwards. SOC 2 is restricted as well, and only SOC 3 is a general use report. Why does scope matter? Those client auditors need this report to complete their own audits. If Cascade excludes so much that the report no longer helps them, that can be a reason to decline. Once all of that checks out, we document the terms in an engagement letter, and the detailed planning begins. Now the real work of planning, understanding what we are examining. And it begins with a boundary question. Where does the system stop? Cascade's system is not the same thing as Cascade the company. The system is the service we are reporting on, together with the components that deliver it. 5 components: infrastructure, software, people, procedures, and data. So payroll processing is inside the boundary. If Cascade also sells tax consulting on the side, that is probably outside it. Draw that line clearly and write it down, because everything that follows depends on it. Now follow the boundary outward. Cascade does not own its data center. It rents capacity from a cloud hosting provider. That provider is a subservice organization, and the term is narrower than it sounds. It is not any vendor Cascade happens to buy from. It is a vendor whose controls Cascade depends on to achieve its own control objectives. The company that stocks Cascade's break room is a vendor. The company hosting its payroll servers is a subservice organization. There are 2 ways to handle one. The common approach is the carve-out method. Carve-out means what it sounds like. We exclude the provider's controls from our examination. We do not test them, and our opinion does not cover them. Cascade has to disclose that in the description. It also has to identify the complementary subservice organization controls, the things Cascade is relying on the host to perform, such as keeping the servers physically secure. The client and its auditor may then need additional evidence about the host's controls, often through the host's own SOC report. Here is what Carve-out does not remove. Cascade still has to monitor that provider, review it, read its SOC report, track service levels. Those are Cascade's controls, not the host's, so they remain in the description and we test them. Carve-out excludes the provider's controls. It does not exclude Cascade's oversight of the provider. The other approach is the inclusive method. Inclusive means we bring the provider inside the boundary. Its controls go into the description and we test them ourselves. It is rare, and here is why. 3 things all have to happen. The provider has to sign its own assertion, meaning its own management putting its own name on its own controls. We have to be independent of the provider as well, not only of Cascade. And the provider has to give us access to its systems, its records, and its personnel. Persuading a major cloud host to agree to all 3 is difficult, which is why the carve-out method is much more common in practice. The same logic runs in the other direction. Some of Cascade's control objectives only work if the client does its part. The client has to approve the payroll register before Cascade releases the money, and the client has to notify Cascade when an employee is terminated. Those are complementary user entity controls, or CUECs. Take the term apart. Complementary means they work together with Cascade's controls. User entity simply means the client. So, controls the client has to operate for Cascade's controls to do their job. And be careful here, because a CUEC is not every duty a client happens to have. It is only the ones the control objectives actually depend on. They belong in the description so that both sides know which link in the chain is theirs. Let's lock in what we have. Before we accept, we are independent and competent. Management accepts its responsibilities and signs the assertion. The criteria are suitable and available, and the scope produces a report someone can use. Then the terms go into an engagement letter. After that, we map the system, draw the boundary, work through the 5 components, determine whether a subservice organization is carved out or included, and identify the complementary controls on both sides. That is the foundation, and everything in Part 2 is built on it. If that made SOC planning clearer, subscribe. In Part 2, Materiality, when there is no financial statement to measure against, we assess the 3 risks and how those risks shape our procedures. I'll see you there.